Hello, it is Webinar Wednesday, and I'm very excited. So we have Stephanie with us today, Stephanie Vaught. She's with us, and she is the founder of Social Money Finance. And I'm going to be honest, I told Stephanie this before. I totally stalked her online. She was posting all this stuff that had to do with money, and I thought, who is this woman? And she's got some really good content there, so I highly recommend that you follow her. But she's in the Detroit area. She's a financial educator. She has a background in law, so don't be scared. She's one of the good guys, good women. She's coming in here. But she also is a natural speaker on this area of personal finance. And that is what she is going to be chatting with us about today and sharing her love of credit and taxes. It's very apropos for right now. But I welcome you to Webinar Wednesday, and I'm going to let you take it away.
Okay, sounds good. Hi, everybody. My name is Stephanie Vaught, and I am the founder of Social Money Finance. And I want to thank Cheryl Hickerson, so much of Females in Finance, for inviting me on to do this webinar for you all. I am excited about this. As I mentioned to Cheryl, this is my first webinar, believe it or not, and I've said on many, but this is my first one hosting. So I am very excited to talk about the subject of credit and what it means for everybody, how we tackle it and deal with it once and for all. So just a little bit of housekeeping. What I'm going to do is share my screen so that way you can see what I'm doing. You'll see me in the corner perhaps. But I'll share my screen so you can get a feel for everything that I'm talking about. And then I'll check back in. If there are any questions in the chat, I'd be more than happy to answer those. I'll check back in with you all to make sure you're following along. And if I need to explain something or make something a little bit clearer, I'm certainly happy to do that. And if you are listening to a replay, you can always reach out to me and I will give my information at the end. So I am looking forward to this, and let's go ahead and get started. So give me just a moment to share my screen here. Okay, so I just want to give me 1 second. That way you see the slides. Okay. All right, so let's definitely jump in and get going. So as I stated, my name is Stephanie Vaught, and I am the founder of Social Money Finance. And the title of this course is Tackling Credit Once and for All. So we're going to answer your credit questions and give you a nice, thorough overview of what to think about, what to look for when we're talking about credit. I want to give you a little bit of background about myself. As Cheryl mentioned, I am a financial educator and coach, and I got my start in the legal field. I graduated from law school in 2007, and you couldn't tell me any different. I thought I would be slugging it out in the courtroom and doing all the things law. And I did have a pretty varied legal career. I worked some high profile cases, worked with some attorneys, did a lot of writing, but my main focus was community advocacy. And that mattered to me because I've always been, an advocate for the underdog or the little guy. And that's what I did in my legal career. And during that time, I really had this awesome love and developed this love for money and personal finance within that time frame, believe it or not. And so about 10 years ago, I really fell in love with personal finance. And a lot of it had to do with just managing my own household, managing my own money and entrepreneur endeavors. And it's interesting because when you are in school and you're learning all these things, financial literacy is a fundamental life skill. And sometimes, within that, you don't necessarily learn just how to manage your own household. And I found myself in that situation. And so I started teaching myself about money and, what it meant and what it means and how I can maximize what I make. And so that was my initial start into the financial industry, again, about 10 years ago. And in 2015, I became certified in financial counseling and had the opportunity to work with many people all across the country on their financial concerns if they were in financial crisis. And so that was my start into it. But certainly going back to my roots, I wanted to get back into community and work with people, maybe they had a similar background as me, where they learned many things, but maybe financial literacy was not one of those things. So my mission in my company is to help busy professionals and working families build better money management for their households. And I want to make sure you can see this. And what does that mean? Well, money management systems or systems in general, when we think about that, think about your business. If you're an entrepreneur or self-employed or a business owner, we always talk about systems, having a process in place to make things run smoothly. Even in your 9 to 5, having some process to make your role run smoothly, right? So having a money management system is just as important in your household or in your personal finances, maybe even more so. And so I wanted to build a company that focuses on that, certainly for busy professionals and working families, that they have a system in place that helps them as they are going through. So as I said, where did it all begin? Well, like I mentioned, I started my career in the legal field thinking I would be doing all things law. And when I fell in love with personal finance, I really wanted to ensure that I knew what I was doing, and then certainly taking on the role as a financial counselor, being able to impact people on a very broad range. And talking with people from all walks of life, all income levels and education levels. And one thing I want to mention is that financial literacy is a fundamental life skill at any age and any stage. It doesn't matter your income level, it doesn't matter your education level. It's so important to know how to manage your money. And again, it doesn't matter how much money you have, right? So in doing that, I wanted to, in starting this company, bring it back to community and really walk with people that maybe, of a similar background that needs or wants that money management skill and financial literacy skill. And so I built Social Money Finance, and here we are today. So I want to talk about the money management system components. And that is a social money finance framework. So as I mentioned, this class is specifically about credit, but I want you to understand how credit interacts with an entire framework. So the first being, and I'm just going to go through these really quickly so you get an idea of what we're talking about, but the first being income. Obviously money that we're managing, it has to be money that we're bringing in. So the very first thing we're talking about is the income. And this is all sources. This can be from your main source, your side hustle, your business income, but what money are you bringing into your household? The next component is your money mindset. And this may even be the most important of the components because it shapes how the rest of these things interact with each other. And your money mindset, it comes from your upbringing, your childhood. What did you see growing up? What did you learn? What did you observe? And that translates into your adult experiences. Did you have some trauma as it relates to money? Did you experience some great things as it relates to money? So your mindset is your relationship with money and how you view it. There are certainly mindsets to consider, but for time purposes, we're just going to talk through how it works in a larger system. Mindset, of course, leads to your money habits. The third component of this framework, your habits are how do you spend your money? What do you do with it when you receive it? Do you spend it on yourself? Do you prioritize your needs? How do you spend the money? What is your habit with the money once you get it? And then moving down to the budget and spending plan. Spending plan or budget, is just another word for spending plan. It is the method in which you track your money. How do you track your money? And there's several ways to do that, whether it's through an online app or an Excel spreadsheet. If you have cash envelopes, there's many, many ways to do it. And if you are doing it, what method do you utilize? What picture do you have that indicates your cash inflow, the money coming in, and the money going out? Okay. And then, of course, the next line item down or next component is credit usage. And that's what we're talking about today. We're talking about credit. But again, just seeing how it fits into a larger framework. How do you use credit? It means something different for everyone. And we're going to talk about that. Your debt payoff. Everybody nowadays, right? Most of us have debt, whether it's student loans, a mortgage payment, or car loan, but most consumers have debt, and there are many ways to pay it off. But how do you go about doing that? Do you pay it in a lump sum, monthly payments? Are you on payment arrangements? So there's many different ways to tackle that. And then the last three are savings plan, investment plan, and your overall financial goals. And it's really important to look at this as well, because your savings plan, many of us have heard emergency funds or saving for a specific purpose, which is what a savings plan is. Usually it's a short-term use. Investment plans are your longer term uses, or maybe your future plan for your money, your retirement plan. And then certainly financial goals is just the overall things that you want to accomplish with your money. So again, this is our social money finance framework of how you create a money management system. And these are the components of that. So I want to talk about credit. That's what we're here for. And this course is going to be broken up into three parts. We're going to talk about credit in general and credit cards, because that's what most of us want to learn about, right? Credit report, what is actually on your credit report, and then your credit score. So that's how we're going to break up the course. And again, I'm going to check back in with everyone to make sure you're still doing okay. Let's check in the chat and see if there are any questions or from any participants. Do we have any questions right now?
No, we're good right now. What I was going to say was, and everything looks really great. I don't know if maybe the earbuds, or when you're typing maybe, or when you're switching the line, it might be catching the sound from it, but it's not terrible. But I just thought I'd bring that up. But outside of that, no. I do have one question at the end, because
Sure.
one of the things I hope you'll talk about that has to do with credit is commingled credit debt. Because when I got divorced, 2.5, 3 years ago, I did not realize what an enormous burden commingled credit is. And for those who do listen, it is when you get a credit card and you add a spouse, which we naturally seem to think to do. I hope you talk a little bit about that, because I learned a whole lot about credit when I got divorced.
Absolutely.
So, yeah, if you get to the point when you're talking about cards, what your feelings are about having a credit card of your own versus having a credit card together versus having an authorized user. I think that those differences seem really small, but they're not. They're huge.
Absolutely. That's such a great question, Cheryl, and I will make sure that I touch on that as we continue on. So absolutely. So I'm going to go ahead and share my screen again so you all can see what I'm doing here. All right. So bear with me just 1 second here. Okay. So we are back to the slideshow, and let's keep going. Okay. So credit in general is a tool, right? Credit is a tool. And what that means is it represents something different for everyone. And I say that often because it does. People use credit in different ways. But one thing to note is that credit is borrowed money, right? So a lot of us know that, but it's important that you know that credit is not to be added to your bottom line. So let's say, for example, you make $5,000 a month, but you have a credit line or credit limit, that has a $10,000 available balance on it, right? Your bottom line doesn't then move up to 15,000. It's still at 5,000. So you want to ensure that you're not using credit as money, as your money. It's borrowed money from a lending institution for the purchase of goods and services. And certainly, they are expecting that money that you borrowed to be repaid. So I just want to ensure that I talk about that, but and we're going to develop this a bit more. So the nuances of credit, and as I've stated, it means different things. So having good credit, that is the default position. right? Most of us want good credit, and for many reasons, whether it's access to more financing options, having good credit, or what we're calling good credit, certainly gives you access to better interest rates, perhaps easier loan approvals or business deals, versus having bad credit or no credit. And so we'll talk about that in a little bit more detail. But for other people, some people think, well, I don't need credit. I purchase everything in cash. Nowadays, you don't hear that too often, but sometimes you do. And if that's the case, though, certain jobs require you to have a certain credit score, or certain credit history, or your credit reporting positively. Certain jobs look at your credit report. And nowadays, your car insurance premiums are, those amounts are predicated on your credit as well. So there are many reasons why having a solid credit score and having a good payment history and a good credit report are so useful. So I want to talk about the types of credit cards. As we said, this course is broken into 3 parts, and credit cards is sort of the first element of what we're talking about. So, of course, there's 2 types of credit cards. There's a secured credit card, which requires a security deposit as collateral, and then unsecured. Breaking this down, a secured credit card is generally utilized if someone is recovering perhaps from bad credit, right? Or if they had no credit, or they're trying to establish credit. Oftentimes, a secured credit card is utilized if this is your first credit card. Maybe if you have a teenager, or if you're a college student and you want to begin using credit, a secured credit card is the way to go. Now, keep in mind, with that cash deposit being used as collateral, that gives the lending institution some, it makes you a little bit more risk, where they're willing to take that risk on you, because you have put down a deposit in the event that something happens. So for example, cash deposits usually are like, the minimums are like $200. It could be $500, $1,000, but you can use that credit card just as you would any card. But the collateral is set aside for, in the unfortunate event, if you were to default on your credit card payment, the lending institution would be able to use that collateral that you set aside in that cash deposit to pay back what you owe. And so that is why secured cards for banks tend to, look favorable, and it can help you establish credit. Now, unsecured credit cards are what most of us have, right? That's your Visas, your MasterCards. There's no cash deposit required, no collateral required. And you apply for those, you don't have to put any money down, but they certainly are looking at what your credit score looks like in your payment history, which indicates or dictates if you're approved for that credit card, and if so, what kind of interest rates are you getting with that? So this is just to give you that overview of the types of credit cards that we're talking about. And a couple things I want you to, this is just a quick checklist for you to keep in mind when getting a credit card, or if you have one, it's a good idea to know, what is all of this? What is your annual fee, or do you have one? Some credit cards don't have an annual fee, but some do. So you want to know, what are they charging you on a yearly basis for the utilization of your credit card? Your APR, or your interest rates, those are going to be the interest that attaches to the balance on your credit card that you revolve, or that you carry month to month. Okay, so let's take, for example, you have a credit card balance of $500. You pay some of it down, and maybe $450 revolves to the following month. The APR, or the interest, will attach to that $450 that's carried over. Okay, so you want to know what the interest rates are, and on average, interest rates on credit cards they're high. They're high. They're about 25%, 26, 27%. So we'll talk about this in a moment, but it's a good idea to keep very low balances on your credit card if you're going to have a balance at all. Certainly the best practice is to charge your card and pay it off. But again, we'll talk about that in a moment. Other fees are like foreign transaction fees. If you use the credit card out of the country, keep in mind yours may have that type of fee attached. You want to check that out, especially if you travel quite a bit. See what fees are attached to utilizing your credit card out of the country. Late fees. You can be charged a late fee for paying even a day late. So really understanding your billing cycle and, when is your bill due? And if you pay it a day late, sometimes you can be charged a fee. Typically though, fees are assessed if you're 30 or more days behind. But again, these are all things to really look at when, utilizing your credit card or looking to get a credit card. The next three are over the limit fees, balance transfer fees, and cash advance fees. Now, over the credit limit fees, usually that's assessed, it sounds pretty self-explanatory. If you max out the card or go over the credit limit, you're charged a fee. Some cards don't let you go over the credit limit. But if you opt into that feature, just be aware that you'll be charged a fee for exceeding your credit limit. And then balance transfer fees. You know how you have those those cards where you get an introductory period of 0% interest for 12 months, right? And some people are attracted to that. If they have, a balance on one credit card, say it's $10,000, and they want to transfer it to the credit card that has the 0% interest, they may do that. Now, two things to keep in mind when doing that. If you transfer a balance to a 0% interest, make sure you can pay that balance that's been transferred within the introductory period. Most often, those 0% interest cards, that period may be again for 12 months, 15 months, 18 months. Just make sure you can pay it off within that time frame, because once that introductory period ends, then you're looking at an interest rate that could skyrocket to that 26, 27, or even 28%. Now, keep in mind, the card that you transferred the balance from might charge you a fee for doing that. So you want to read the fine print and find out if that's something that happens if you are considering transferring a balance. And then certainly lastly are cash advance fees. If you want to withdraw on the credit line that you have, there may be a fee for that. And there may be higher interest attached to a cash advance from your credit card. So again, these are just a quick checklist, what things to look for when getting a credit card or look for with your current credit card, okay? I want to bust some credit myths, and I can't tell you how often I have heard so many of these, but we're going to go through these really fast. The first myth is credit cards are bad. How many of you have heard this, right? Where, it's like, oh, don't get a credit card. Credit cards are of the devil. But here's the thing, credit cards aren't inherently bad, right? It's how you use them. So we'll talk about the best practices in a moment, but it's how you use the credit card. What purpose is it serving for you? If you charge and pay off the balance that you charge, or you charge what you know you can afford, credit cards give you access to certain things, okay? So just keep that in mind. Myth 2 is carrying a balance on your credit card is good for your credit. Not necessarily. Now, you want to ensure if you are carrying over balances or revolving the debt, as we mentioned, that it's a low balance, that it's 30% or less utilization of your credit limit or available credit. And I'll talk about that in detail a little bit more. But if you have to carry a balance, you want to ensure it's a very low balance next to what's available on your credit card. The other thing, though, is in and of itself, it's not good for your credit. It's best to charge and pay it off within the billing cycle. Myth number 3, you need a credit score of 800 or higher to get a credit card. Not so much. Most consumers, the average, I think these days, I think the last statistics out for 2019 was that most consumers have credit somewhere between 650 and 700, right? That's
higher than I thought.
Yeah, it's
I was waiting for you to say like 580 or something. I was like,
well, that's certainly on the lower end, but I guess I should make it even more clear that you don't need an 800 to get a credit card. Now, if you got an 800, right? If you have an 800, then that introduces you to, those great interest rates, maybe some perks that a 700 score won't get you, right? Maybe those MX cards or the black card or whatever these, higher end cards are, but you don't need it and just to get a credit card. And then myth number 4, pulling your own credit report lowers your credit score, and that's just not true. You can pull your own credit report. It's if others pull it, like, if you're being evaluated for credit, if you're trying to apply for credit and it's a hard inquiry, as it's called, into your credit score and credit report, then that can lower your score. But you pulling your own report does not lower it. Myth number 5, close the credit card after paying it off. And that's also another one that's a myth. You want to keep open lines of credit. It's a good idea to pay the card off, but keep it open, because what it's doing is it's showing that you have all types of credit that you've been able to be, approved for, and it actually overall improves your score if you pay that off, but leave it open. Now, use common sense with this. If this is something that is a huge temptation for you and you're feeling like it's not worth it, you'll be tempted to overuse it or utilize it in a way that's not good, then perhaps you may take the hit and close that card. But overall, if you can pay it off and leave it open, that's actually better for your credit score. And then myth number 6, credit repair agencies can fix your credit. I want to certainly touch on this because it's a myth. It can be a myth, right? You have to be careful with credit repair agencies. Now, some, they make these promises that they can do certain things for you, but there are no guarantees. What happens is you pay your money in advance and they investigate a situation that you're wanting them to fix. Right. So if you're disputing something on the credit report and you reach out to a credit repair agency to fix this issue, they will charge you a fee that you pay up front, usually. And there, again, it's just no guarantee that it's fixed. If it turns out as well that the item that you're disputing on your credit report is fair and should be on there, then you are still obligated to pay that disputed amount. And essentially your credit report hasn't been quote unquote fixed. So I just want you to be aware of that. Myth number 7, in having a whole lot of money in the bank account means you have great credit or great credit score. And that's not true either, right? Because the amount of money that you have in the bank is not what is being evaluated on your credit report. Okay, so your bank accounts aren't on your credit report, and we're going to talk about what's actually on it. So don't think just because wealth equals good credit, because it doesn't always. Okay, and the last myth: employers check your credit score. Mostly a myth. Employers can check your credit report, again, if that is something that is needed or incidental to the job you have or the job you're applying for. They may look at your credit report to see to evaluate you in that regard. But getting access to your score isn't always typically what they do. Okay? We're going to move on now to the flip side of this, which is best practices. And we've touched on it a little bit, but as I said earlier, you want to the best practice, right, is pay your credit card balances in full each month to avoid interest charges. So I talk about this because it's so important that, let's say you buy a coat, right, and the coat is $500. If you charge that coat and you pay, you charge it and you charge a solid $500, you want to pay back that $500 within the billing cycle. And usually the billing cycle can range from 23 days to 30 days. So that's why it's so important to understand your billing cycle. But just for, general purposes, let's say it's 30 days, right? If you pay off that charge within that 30-day period, you're not charged interest. There is no balance that revolves or that transfers to the next month. Okay, so there's no interest to charge. And the nice thing about that is you paid off what you charged, right? You paid off what you purchased an item for, versus if you allow interest to accrue, then you're paying more for that item. And the more and more you do that, or the more you charge and don't pay off, you're paying well over what an item or items cost because of interest charges. And remember, we said interest can be 25%, 28%. That's some high interest. So the best practice is if you can pay it off within your billing cycle or 30 days, if that's your billing cycle, that's the best practice. Do keep your balances low. And we talked about this, but when we talk about 30% of your credit utilization ratio, let's put that into an example. So let's just say for easy math, you have $1,000 credit limit on your, as your available credit, right? $1,000. 30% of that, of course, is $300. So a best practice in terms of keeping your utilization 30% or below is to not charge more than $300 in this example, right? Especially if you're going to carry a balance. It's just the best practice because it tells the lending institution that A, you're not at risk to maxing out your credit card, okay? And B is stating that you're being prudent with the credit that you have, right? Or the money that you're borrowing. So that is why it's just a good, rule of thumb to keep your utilization at 30% or below. Plus, it makes up 30% of your credit score. So I'll talk about that in a moment too, but it's a reason for this. Okay. And then do understand, as we said, your billing cycle, do monitor your statement. This is another best practice. Make sure that there's no fraudulent activity on your credit, on your credit card, that no one has gotten a hold of your credit card. So this is actually, and then of course, the last piece of this is charge what you can afford. And I always tell people that, don't charge well over what you can afford, because for one, you may run the risk of maxing out your credit card, but also it makes it that much harder to keep that utilization down and pay it back timely, or even pay it off in full each month. Okay. So just keep that in mind. But I want to pause here for just a moment and answer Cheryl's question about commingling credit, because I think this might be a good place to do that. So if you remember, Cheryl asked the question of, if you're married or in a couple relationship and you're both listed on the credit card. So two ways that can happen. You're both, you as listed as users, right? So you both have equal access to the credit card and both responsible for the credit card. There's also another way of being an authorized user. Okay, so one person has the credit card and is allowing the other person to utilize it. But keep in mind, as an authorized user, you're actually not responsible for the debt. So that one is a biggie. So usually you see those that kind of show up in a spousal relationship, sometimes in a parent-child relationship, maybe siblings. But in both of those situations, a large amount of trust, I always say, is required, because your money habits, going back to, as we talked about, the bigger framework, might be different. So one spouse may be a spender, one might be a saver, or a little bit more prudent, and how they're spending or how they're charging or utilizing the credit card. As an authorized user, you may be allowed to use that credit card, from the card holder, but, you're doing so, and the card holder is doing that with the understanding that they're on the hook for whatever you charge. Now, you could have it where, if you charge something, you give the credit card holder the money to pay off what you charged. Hopefully that's an arrangement that you have, but it's not always the case. And, a lot of times, people are authorized users to boost their own credit, because if that credit, or excuse me, if those charges are paid back timely, then that's a boost for the authorized user's credit report, even though legally they're not obligated for the debt. So it's just a really interesting relationship that has. But if you're going to do something like that, just make sure that, you trust that person that you're allowing to be an authorized user, or that is the credit card holder, because it can certainly impact your credit. Or if you're both listed on the credit card as equal users, really understand their habits and how they spend money, because that, again, that can have an impact on your credit report and credit score. So, Cheryl, did I answer your question?
You did, and the big reminder, at least in my situation, is that when I went, we had an amicable divorce. At no point did I realize when we decided to divvy up debt by my saying, yes, you take that credit card debt, and I'll take this. That it
Mhm.
never dawned on me that my name was still on those cards, like.
Yeah,
And that's where financial educators such as yourself, financial advisors who are listening, you really play a very important role to Main Street USA people today, because it's very emotional, right? Because you're thinking, I
yes,
just want to be away, I want to be separate, I want to be gone. And in the end, when he stopped making payments and my credit score was dinged for it, I had to then be the one who was actually making the payments in the end. So it really
yeah.
doesn't matter. I mean, you can go and settle it other ways, but you're like, it's my credit score. So what you're going to talk about, and that'll make sense what I'm talking about too. But I love that you've talked about all these points.
Oh, awesome. Awesome. Great. All right. So we're going to talk about credit card fraud. And I may have been able to answer the question here too, but I want to touch on this. And I sort of included this because, it's such an important topic. And I know we're out of the holiday season, but credit card fraud can happen at any point. Usually it happens around very high buying periods during, the year. But I'm touching on this because, again, it's just important to know. Plus, as you all know, I have a legal background and I would be remiss not to mention something from a legal perspective. So, credit card fraud is, something that a lot of people have gone through. But a few things to note with this. If you are the victim of credit card fraud, meaning someone has stolen your credit card, then, it's the credit card company's money and not yours. Okay, so keep that in mind. So they have a vested interest in this situation, right? They're going to get involved. So what I recommend is call the credit card company right away to report fraud or a lost card or a stolen card. So if someone has made purchases using your credit card that you did not authorize, then that could be a fraud claim. So you want to call the credit card company right away to let them know what's going on. You certainly have the right to dispute any fraudulent charges, especially made in your name. You can dispute those and have them removed. And as I mentioned, the credit card companies are, vested in investigating this and figuring out what's going on because it's their money that was defrauded, not yours. Okay. But for you, you don't want to be on the hook for purchases that you didn't make or authorize. So the next piece is you don't have to pay. And some people may not realize that. If you're a victim of fraud and it's proven, through investigation and it turns out, that it isn't purchases you made or authorized, you don't have to pay for those. Federal law actually protects you and minimizes your liability for unauthorized credit card purchases. So you don't usually have any liability with, the major networks like it says here in the Visas and the MasterCard. Okay. And keep in mind, with those sort of mainstream companies, they have a lot of, first of all, insurances in place to protect themselves, as well as investigative processes and procedures that are in place to protect themselves as well as you. So that's another, I guess, perk, if you will, of utilizing a credit card, because if you are going to do that for purchases, then and you are defrauded, or the credit card company is, there are some things in place that can protect you. And then lastly on this slide is you're issued a new credit card with a new credit number or with a new account number. So after you call the issuer or the credit card company and let them know that there's been fraud committed on your account, they'll cancel the card. Usually they cancel it out right away, even pre-investigation. Okay. So that stops any usage of the card. And then once everything is squared away, they send you a new card. Okay, so just keep that in mind. If you have been the victim of credit card fraud and you're not totally sure what to do, you have these things at your disposal. Okay, so next, again, talking about consumer protection or consumer credit protection laws. This is really just for your information. You can take a picture of this, you can write it down, but there are laws in place to protect you. And one of the many things that I am so vigilant about when it comes to working with clients or just doing education in general is that consumers is when you're an educated consumer, you're a powerful consumer, and realize that there are laws in place to protect you. So if something is going on that you deem unfair, if you're being bullied, if you have questions, these laws are here and were enacted some time ago, as you can see, to protect your rights and protect you as a consumer. So just know that, okay? So next up, as I mentioned, we are out of sort of the credit card phase of this course, and we're now transitioning into credit reports. Okay, and it's important to know what the credit or who the credit reporting bureaus are and what's actually on your credit report. So the credit reporting bureaus, the major ones are Experian, Equifax, and TransUnion, right? And they, it's a detailed report of your credit history prepared by this bureau. So the credit history is your payment history. It's, all kinds of things that show up on the credit report that are important. Whether if you have positive payment history, that's on your credit report. Any negative or delinquencies, that shows up as well. So just keep that in mind. And if you want to pull your own credit report, you can go to annualcreditreport.com and you can request all three, so meaning from those credit reporting bureaus, for free. And you can do that one time each year. So you can go to that website one time each year and pull your credit report. And the reason why it is so important to do that is because each credit reporting bureau, they may report differently. And this goes to making sure that things are reflected accurately on your credit report. So you want to see all three, right? Especially if you are looking to use credit for a major purchase, like buying a home. Some people are using credit, to purchase a vehicle, or again, just some major purchase, and you want to know what's on there before you start to apply, and how each credit reporting bureau is reporting out your information. Also, lastly on this, if you are looking to get approved for certain kinds of credit, again, whether it's a mortgage or even a credit card, find out what bureau they use. What bureau does that lending institution use? So that way, you know how your credit is being reported there as well. Okay, and then of course we talked about what's on the credit report. Again, personal information like your address and all of that, your credit history and credit inquiries. So if someone is evaluating you, if there's an institution evaluating you for credit, that will show up on your credit report. But what is not on there is, again, important to know, is checking and savings information. So that goes back to what we talked about. Your bank account does not reflect on your credit. It's completely independent. Certainly race, religion, gender, political affiliation, none of that matters, and none of that is reflected on the credit report. Okay, so one of the major questions I get all the time, and I wanted to ensure that I spoke about this, is how long do items stay on the credit report? Okay, and this typically is raised when someone is, looking to get approved for something where credit is important, and also if they are wanting to dispute something that's on the credit report. That's usually when this becomes of interest to people. So you can read through this list, but just really quickly, open positive accounts are indefinitely. So that's good news. So if you're paying your bills on time, whatever bills you have that report on the credit, so that can be your credit cards, any loans you have out like mortgage or car loans, student loans, even a utility bill. Some utility companies report on the credit. If you're paying all of that on time, it reflects very positively on your report and it stays on indefinitely. Closed positive accounts with no negative history. If you've closed them out, but they're positive, they stay on 10 years from the close date, and then they age out. Eventually, they drop off. Late payments, and including student loans. Okay, I have student loans. I know how important this is to so many people. This has been such a discussion in our country, and I'm sure probably worldwide, but they do show on here. If you're late, it shows, and typically it's 30 or more days late, and it stays on 7 years from the original delinquency date. Hard inquiries, as we talked about, like, you're looking to be approved for credit, applying for new credit or a loan, up to 2 years. So that's, another best practice. Be mindful of how many times you apply for credit, how many times, going store to store and, trying to get a store credit card, or shopping for mortgages, or shopping for a vehicle. Each time that institution or company checks your credit, that is considered a hard inquiry, and it can actually ding your credit report, or and show up on the credit report, but ding your score. Okay, so just keep that in mind as you are looking or applying for new credit. Medical bills show up 7 years from the first delinquency. Civil judgment, tax liens, foreclosures, typically all 7 years. A Chapter 13 bankruptcy is 7 years. A Chapter 7 bankruptcy is 10 years. Okay, that's how long they stay on the report. So, keep that in mind for these types of things that might show up, in your lifestyle. Okay. And then we talked about this a little bit, but I just want to give a brief overview of how to dispute items on the credit report. We talked about credit reporting agencies and what they do, or credit repair agencies, credit repair agencies. You can actually do what a credit repair agency does, or what you're paying them to do. It is time consuming. I won't disguise that. It takes time to go through your credit reports, look at what you're disputing. And the reason why, I'm going to go back for a second, the reason why this slide is important is so that you know how long an item shows up on the credit report. You don't want to make a fraudulent or a claim that's frivolous, right? When you're trying to dispute, you don't want to make a frivolous claim because it wastes everyone's time. Okay. So let's say, for example, something's on your credit report that you're saying, hey, I didn't even make this charge. That's why it's so important to evaluate your own reports. But also, this is so old, why is it still on here? Those are the kinds of disputes that you can, make. So what you do, as it states here, is you send a letter to the Credit Reporting Bureau, and I would send it to each one that has the item that you're disputing. Send a letter, tell them about the inaccuracy, give some proof. Okay, so if you're disputing something, make sure you have something in writing or something that shows proof of the dispute and why it should be different. And then bureaus are required to respond. That's something that a lot of people don't know. It can take up to 35 days to investigate and respond. Check back in with them after 30 days. Again, this is your rights. This is why we talk about this, because you do have rights as a consumer. Okay, so we talked about credit repair agencies. I don't want to, belabor this too much. I've kind of talked about what they do. They pull your credit reports. They write up a dispute letter for you. You have to send them all the documents. Again, this is something you can do. A lot of people utilize credit repair agencies because it is time consuming and they'd rather just pay someone to do the work for them, which is fine. Just ensure that the repair agency is reputable and that they are diligent in what their claims are, because you've paid them, right, to do this work. And again, beware, there's no guarantees, okay? But disputing items on your report is worth the time, especially if it's impacting your credit score, and especially if it's impacting your ability to get approved for certain credit that you need, whether, again, buying a house, getting a mortgage, getting a job. These things can have impact. So it's worth it if you believe that it's a valid dispute. Okay, so I'm going to stop here for just a moment because, as I said, we have talked about credit and credit cards. We have talked about credit fraud, credit card fraud. credit reports, what's on them, how you can dispute things that's on them. And so we're in sort of the last part of this course, which is the credit score. And I want to just check in with our participants and ask if you have any questions. I am going to stop share for just a second and check out the chat room. Does anyone have any questions?
There's no questions on there yet. I know that we're coming up on the hour, so we have about 8 minutes until we close out. And I think you've really went through a very thorough list on this. And I know that I actually took like a whole page of notes here. I was writing as you were talking. So you see me looking down, everybody. It's because I do have pen in hand and I'm writing. Like, I didn't know that. I didn't know that.
Right.
So we are learning as we go along. And people can always follow up with you too, couldn't they, Stephanie?
Absolutely.
Afterwards, what would be a good way to get in touch with you?
Yeah, so I am definitely going to talk about that, but you can reach out to me on my website, which is socialmoneyfinance.com. Very simple, socialmoneyfinance.com. And you can work with me. You can work with me in one-on-one coaching. I'm going to put my website in the next couple slides as we're wrapping up here, so you know how to get in touch with me, how to work with me. But yes, absolutely, you can follow up via the website. Also, you can email me at stephanie@socialmoneyfinance.com. Stephanie, STEPHANIE, @socialmoneyfinance.com. So I want to definitely wrap up and get through the last leg of our course here. So I'm going to go back to sharing my screen so you can see what I'm doing. All right. Okay, bear with me a moment here. Okay. Okay, so we're in the last leg of the course, as I mentioned. So we're now talking about credit scores. And I want to certainly give you an overview of how a credit score is broken out, like what all makes up a credit score. And it's sort of this convoluted system that has been, formulated, certainly, something that it's kind of a mystery, to be honest. But what we do know is the way that the credit score is the way it's evaluated from a percentage perspective. So 35% is your payment history. That's typically the most important part of the credit score. Okay, your payment history. And what that includes, as we've already talked about, is the way in which you pay your bills. To make it as simple as that. It's if it's positive payment history, if you've paid everything on time, that shows up on the credit report and is certainly reflected in the credit score. And certainly any delinquencies or late payments, that will show up in your payment history. And so again, that's 35% of your score. 30% amounts owed is your credit utilization, something we've already talked about. But again, that's why it's such a good idea to keep your utilization at 30% or below, because it does make up such a large part of your credit score. Now, even though payment history makes up 35%, I always say that your credit utilization, or the amounts owed, is honestly almost more important, because it shows, if you are then becoming a credit risk. Right? So if you're in danger of maxing out your credit card, or if you are, spending almost up to the limit, that makes you a risk from a lending institution's perspective, that you either will run the risk of not being able to pay your balance in full, or you're carrying very large balances month to month, accruing this interest that will reflect poorly on the credit report. So just keep that in mind. And then 15% is your length of credit history. So how long have you had, your credit cards or your various, credit? How long have you had that? That makes up 15%. New credit, again, that's going to how often are you applying for credit? So that's 10% of your score. So make sure that any, new credit that you're applying for, that it is necessary. You're not sort of randomly applying for credit, and again, those store credit cards, which can trap us a bit because it all reflects on the credit score. And then lastly, the type of credit used. Okay, and this is important too. Even though it's just 10%, it's the different types of credit that you have been approved for, the variances or the variety of credit. So someone that has one credit card versus someone who has a credit card, a mortgage, a car loan, it's showing that when you have a variety of credit that you've been approved for, it's showing that, you are a person that can be approved for different types of, credit from that lending institution. And then if you're paying all of those bills on time, that reflects very positively from a credit score perspective. Okay, so just keep that in mind. But that is how a credit score is evaluated and what makes up a credit score. Okay, so I want to talk about what drops a credit score. And I am often asked this question and definitely wanted to include this in the course. Late payments drop a credit score, and that's typically if a payment is 30 days or more late, it then shows up on the credit report. Okay, so even if you're late, like with your credit card or with your mortgage or car loan or whatever it may be, you may be a day late, you may be 2 weeks late, and it's still late, right? And you may get a late fee, but it typically doesn't show up on the credit report until it's 30 or more days late. Okay, and that impacts the credit score. New lines of credit, we've talked about that. Large purchases. So because again, that goes to your utilization. So going back to the example, if you have an available credit or credit limit of $1,000 and you make a purchase for $900, your utilization, you've utilized practically all of the available credit to you. And so that can actually drop your score a bit. If your credit limit is lowered. Now, sometimes that happens if you've had a history of paying your credit cards late. Okay, they may then lower the credit limit because it's indicating that, it may be that you're overspending or you're not managing money properly, right? So from a lending institution's perspective, they may say, well, we need to lower this credit limit because, maybe they have too much credit and they're not utilizing it properly. So if your credit limit is lower, that can drop the score. And it also, again, going back to this credit utilization, that's why I say utilization is so important, because in that same example, let's say your credit limit, again, is the $1,000 and your limit is now lowered to $800. $300 balance against $1,000 credit limit is 30% utilization. But then if your limit is lowered to 800, that increases your utilization, right? And so that again will lower your score. Closing a credit card, as we stated, that can lower the score. We've talked through that. And then inaccurate information on your credit report. So again, all reasons to be vigilant with knowing what's on your credit report. How much does the score drop? That's certainly a question I get often. You can read through these. But if you're 30 days late, 60 to 110 points, that's quite a bit. That's quite a bit. And that's the Money Talk News that's showing where I got those numbers from. So you can certainly go to Money Talk News to see more about that. Debt settlements, foreclosure, bankruptcy, maxed out cards. All of those, you can see how much your score can drop with these things reflecting on the credit report. Okay. How to improve your credit score. We've touched on this as well, but maintain low balances and never miss a payment on the credit cards. And certainly if you can pay off the credit cards, charge them, pay them off, charge them, pay them off, that's the best way. Getting a cell phone or utility bill in your name and paying it on time. And I touched on this as well. Some people don't realize that that is another way that you can improve your credit score. If that's what you're really working to do, maybe right now, if your credit score is on the lower end, okay, and you are looking for ways to improve and you can't get approved for a credit card, perhaps you do want to get a utility bill in your name and pay that bill on time. So that way it's showing some positive payment history, at least in this one area. Okay.
You know what, Stephanie? I highly recommend people set their bills on auto draft to be paid, like the minimum payment to be made. So you're always making that minimum because you might be traveling,
Absolutely.
whatever it might be, and you don't want to miss those critical payments.
Absolutely.
And when I got divorced, and going back to the credit thing that we talked about at the beginning, I immediately set my bank accounts to pay those minimum balances. And it literally, I watched my credit just go, just missing one.
Yes.
One. And they don't care. They want their money. They don't want to hear your story. They've heard every story imaginable.
Right.
And they don't care about your vacation, that you travel, that you got stuck, that you whatever, fill in the blank. But just, I mean, I don't know what your opinion as an expert in this space is, but I always tell everybody to put their bills on auto draft for that minimum payment.
Absolutely. And I think that's such a great idea, Cheryl, especially if your income is consistent. If your income is consistent, then yes. I will say, if you have inconsistent income, be careful.
Yeah.
You know, if you're going to keep the bills on auto pay, make sure you have those due dates, you know, established in a calendar, in your phone, something that you can look at regularly so you know when they're coming out, and ensuring that you have the money in there to cover them. So that's the only caveat I would make. But if your income is consistent and you know when things are due, then yes, absolutely, I would encourage auto pay as well. And then the last few things of this, again, we've touched on it. Only apply for new credit as needed. Keep your unsecured credit cards open as long as there's no annual fee. And that goes back to that credit card checklist I talked about. Keeping the card open, sometimes you can use it and make small charges and pay them off. But if you have an annual fee on there that's charging you, you know, I don't know, an exorbitant amount every year, again, using common sense, it may be worth it to close. And then, of course, disputing any inaccuracies on the credit report can help improve your score. Okay, the bottom line, and we're at the end of all of this, is pay on time, pay in full, and keep a low balance. That is the bottom line on improving your credit score, which, of course, we have talked about. So we have covered the three parts of this course, again, which was credit and credit cards, credit reports, and credit score. And so certainly, as Cheryl had already asked, I'm giving you an opportunity to work with me. With my company, I do financial coaching, one-on-one financial coaching, as well as couples coaching. And we talked about the money management components in the framework that we have under social money finance. And credit is just one part of the framework, right? We were talking about credit, but all of those elements make up a money management system. And so working with us, we will teach you that system. And absolutely, if you're doing one-on-one coaching or financial couples coaching, we can talk with you and work with you on your own individualized plan for that system as well. So I invite you to book a call. Generally, what you do, again, you can go to my website, socialmoneyfinance.com/services. You can start with a free discovery call and let me know how I can help. Let me know what your specific questions are, what your financial concerns are, and I'd be more than happy to talk you through a process. And then you would book whatever service fits your needs, whether it's an individual session, couple session, or even a monthly session. Okay, I'm showing some reviews here, letting you know kind of what people are saying. You don't always want to hear that I think our company is awesome, but people that we have worked with, some of their reviews and things that they have shared with us and how helpful it's been. So I certainly appreciate all of that. And, I want to close it with saying that successful money management is freedom. It equals freedom, because here's the thing. As I mentioned, credit is just one component of a much larger system. But when you have successful money management all the way around, you know where your money's going, you tell your money what to do, you're in control of it, you have a handle on how much credit you use and what it's being used for. You have access to, a savings plan, investment plan, you have set financial goals. All of that is included, and it equates to a sense of freedom that you have, right? When you are in control of your money, when you're able to manage the inflow of your money, so the income, as we talked about, coming in, and the outflow of your money, which is your prioritized expenses, your rewards, your discretionary spending. When you're able to manage all of that, and utilize healthy credit practices, it again, it gives you a sense of freedom that you're feeling more in control of your situation. So again, I just invite you all, if you're interested in financial coaching, one-on-one assistance, certainly book a call with me. You can go to socialmoneyfinance.com/services and book a discovery call. Let me know how I can help. And I appreciate so very much you all listening to this webinar, taking this credit course with me, joining me for my first webinar. And if you are listening on the replay, you can absolutely get in touch with me at any time. You can email me, Stephanie@socialmoneyfinance.com, or again, going to my website, socialmoneyfinance.com, to book a free discovery appointment. But I really look forward to working with all of you, those who get in touch. But either way, I wish you great success in your financial endeavors. Thank you all.